So I have another question that came in. It says, what are points and are they worth purchasing? So points essentially are, or discount points are essentially upfront interest. Um, and they're fees paid to the mortgage lender at closing in exchange for a better rate. And we often refer to this as buying down the rate or paying interest upfront. Um, a lower mortgage rate can reduce your monthly mortgage payment to help you save more money over the course of the life of the loan. So if they ask you to pay $3,000 today and it gives you 0.5% interest better, hey, you're going to make that money back within a year, and then you're going to lock in a lower rate over the next 30 years, saving you a lot more than the $3,000 that you originally paid up front. And in today's market, you want to take advantage of all the incentives that the market has to offer, especially considering interest rates when the market out there is rate sensitive. So discount points may be worth the cost if you need to lower your mortgage rate and lock it in. And if you can, and it will also, and also if you can afford to pay higher closing costs, because those upfront fees or those discount points will be embedded into your closing costs. So if you have the cash set aside to pay discount points up front to lock in a better rate, I recommend you do it depending on your situation. The next question that came in is what's the difference between an interest rate and an APR? Super easy. Think of interest as the cost of borrowing money. That's it. I'm giving you the money, it's 5% interest. Now APR, annual percentage rate, would be the cost of borrowing that money, the interest rate that I'm charging you on that loan amount, plus all the other points and discount points and origination fees, all the other fees associated with the cost of putting that loan together to secure it for the next 30 years. So the term interest rate and annual percentage sometimes are used interchangeably. And so APR takes into account the cost of the mortgage insurance, interest, closing costs, discount points, and origination fees. So save that into your cookie box. You're going to need it so that way you know when they give you the loan estimate how much interest they're offering you and what the APR or the cost of putting that loan together is going to cost you in an annualized form percentage. The next question that came in are what are the best ways to save or budget for a mortgage loan? So number one, I wanna address the word budget. So budget for me is a constrictive word. I prefer to use the word spending plan, right? I want to have a plan on how to spend my money rather than budget and just be constrictive all day, all year. So buying a home involves budgeting and saving up for mortgage-related expenses, such as that down payment and closing costs. So for me, is you want to develop an idea of how much you need to save. I want to buy a $300,000 house and I want to come in 10% conventional. Well, 10% of 300,000 is 30 grand. How long will it take me to save the 30 grand for the down payment plus the closing costs? And so it will require me to save and adjust my spending plan, right, in order to spend less than I earn to accumulate those cash reserves for that future expenditure. For example, you can cut out certain categories of variable expenses or downsize before a purchase. Automating your savings can ensure that you're depositing money into your major purchase account. And also, you can maximize your saving efforts by saving 100% of windfalls that you get, such as gift money, work bonuses, and tax refunds. Don't spend Uncle Sam's on just frivolous expenditures. Put that money to work. And the best way to do that is to spend it on yourself, buy yourself a house, and pay yourself that equity. Don't give that money to your tenant. Next question that came in is, can I finance my investment property? Yes, sir. Yes, ma'am. 100%. Getting financing for an investment property can be a little bit more challenging than a primary residence, but you can actually do it. From a lender's standpoint, investment properties are riskier than a primary residence type of property. And that's only because mortgage insurance does not typically cover investment properties, which will require you to put a more hefty or significant down payment, usually 20%. So yes, you can absolutely invest, and actually you can absolutely finance an investment property. You can put 20% down, and there's actually something called out there a DSCR loan, so debt service coverage ratio, DSCR. I'll put a lot of these terms in the comments below so that way you guys know the vernacular that we use in the finance world. And then last but not least, the last question that came up are, what are some helpful tips to ensure that I can repay my loan? Super easy. So a mortgage pre-approval determines how much you can afford. Let's say I pre-approve you for $500,000. That doesn't mean you have to go and buy a $500,000 house. Let's say, for example, you're you're single, no kids, no dogs, no nothing. Do you need a five bedroom, $500,000 house with 2 pools? Unlikely. Get yourself what you need, a 1 bedroom, 2 bedroom, 3 bedroom, but you don't have to wild out and max out, you don't have to purchase a property at your max budget. So to ensure you can repay your mortgage, don't borrow more than you can reasonably afford.